Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged with Nigol Koulajian, founder and CIO of Quest Partners. For you to explain this, this is not, a lot of people will have difficulties in sort of getting their head around these type of concepts because it's a little bit more than traditional trend following. You buy when the price move up and you sell when the price move down, and so on and so forth. But what I wanted to ask you, because you mentioned in the beginning of our conversation that your upbringing in Lebanon actually influenced the way you design your systems. So now I want to try and bridge that gap between these very complex models that you just described and your upbringing in an inherently unstable environment. How does that work?
Thanks for the interesting question. Well, you see, we see the world based on our memory of what it's supposed to be like. It means most people see the world based on their own filters of reality, not based on how it is.
Right.
Okay. So I have filters. People who grew up, in New York and have never seen a war have a different type of filters.
Sure.
So my filters, when I started out as a kid, my grandfather, who basically lived in the Ottoman Empire, always warned me that, always question the system. Don't believe that a system which looks strong means that it's stable, that things can reverse at any point in time. Diversify geographically and don't bet everything on the economy. So you should have, some money in cash, some money in real estate, some money in economic activity such as the stock market. And I remember his warnings, and these were not just philosophical warnings. I mean, for him it was very emotional because he had been through this and he had to run away from the Ottoman Empire, and therefore went to Lebanon, which is where my parents grew up.
Sure.
Now my parents, I saw again the war in Lebanon, the devaluation of the currency.
Right.
And people who had made a lot of money lose it very, very quickly.
Sure. Because
they were convinced of something. So based on the background of my grandparents and then my parents, I basically would rather assume that the world is not a stable place rather than assume that it is a stable place.
Sure.
Now, if you're too scared, then I would say you become dysfunctional.
Right.
But if you're too comfortable, which is in today's world, I would say people are way too comfortable, then they're allocating to a different type of strategies. So here's how it goes into the hedge fund world. The hedge fund world, people don't like to have, effectively, today, people assume that there's no risk. I mean, relative to history, we're trading at volatility levels which are lower than anything recorded.
Yeah.
You look at the foreign exchange rates, you look at the stock market. Now, this is a part of the culture that the typical investor is in. The Fed always comes in and saves you. At the end, we always come back.
Right.
It's a very dangerous idea because in case you're wrong, you lose 90%.
Sure.
Yeah. So the stock market lost 50% in 07 to 09.
Sure.
And without the Fed intervening, I would say 70% was like a question of days, not very far, right?
Sure.
For me, it's important that I allow my ideas to be wrong.
Yeah.
Okay. So now, how does that go into CTA territory? It goes in terms of the market regimes have to change and my strategy has to stay alive.
Right.
One. Second is, if a big move comes, I want to benefit from it. I don't want to pay the price for it. So I want to be a buyer of insurance, and I want to get paid for it.
Yeah.
And by what we've done since we started trading, which means we've generated about 9% of annual alpha to the S&P with positive skew. It means we were not buying based on value. The cheaper the market gets, the more convinced we are right, and we buy more.
Yeah.
We're actually benefiting. We bought insurance and we got paid alpha on top.
Sure.
So 90% or more of the hedge fund industry is negatively skewed. It's becoming more negatively skewed because the idea which is sold by, the common mindset today is that things always come back. It's like it's unpatriotic to assume that the stock market can go down.
Yeah. I mean, it's funny you say that things always tend to, or people believe that things come back. The only thing they don't seem to think is coming back is the CTA returns themselves.
Well, today, okay. Yes, there's been, I would say, CTAs have gone through 5 years of relative difficulty. The CTAs that have done well typically have done well because they've sold into the system. It means they've actually gone long the stock market.
Sure.
But the market is not like a money printing machine. It's there to reward people who do things that nobody else wants to do. That's where the risk premium is.
Yeah.
I'm not saying CTAs. Of course, today you have to start differentiating between CTAs. Because we know the 7 factors, we know that most CTAs today are not really CTAs anymore. We have to make sure we cannot talk about CTAs as one broad bucket anymore.
Yeah.
So I cannot tell you when the situation will reverse, but when it will reverse, CTAs will make back all the time lost.
Yeah.
It means when vol compresses, so you take an equity curve, which is a straight line up, and then you flatline it or you take it down into a drawdown. When the correction ends, you will see that you go back typically to the level that you would have been if you had continued in a straight line up.
Right.
So compressing volatility and distorting markets is not a problem, but when the markets go back, they always go back to reality.
Sure.
They don't go back to another, dream world. So reality at the end always wins.
Sure. And that obviously is why in the long term, these strategies have done better than most hedge fund strategies and certainly better than the traditional asset classes. But people, in this case at least, have very short memories because they, tend to only think about the last, couple of years where, CTAs have done not so well and equities have done really well. So, it's fascinating because, I mean, I see now the link between or at least that's my interpretation of what you said, your upbringing in an, unstable world. And now you focusing on volatility, which is, in a sense, an expression of stability or lack of it.
Lack of it, yeah.
And so I see that link, and which is really, really interesting. Now, tell me, so we have these models, and clearly the way you've designed them is unique in many ways. But in addition to the models themselves, what about something like position sizing? Because in many respects, I think that position sizing is an undervalued, a factor by many people. They think that, it's about where we buy and where we sell. But actually, trend following, if we take that as an example, is very much about how you size your position in terms of what returns you get. So how does that work in your models?
Yeah. So again, very good question. And broadly, the way I see it, value strategies, mean reverting strategies, typically increase their position size as they're losing money. The hedge fund industry overall increases its exposure to the stock market when the stock market goes down.
Sure.
If you look at beta non-linearly, it's measurable.
Mm-hmm.
From the perspective of CTAs, or if you're looking for vol expansion, it's exactly the opposite. It means you're expecting that your position size will increase as you are making money. Okay. So the position sizing now, before we talk at it at a micro level, broadly speaking, you would expect that a CTA, as trends develop, that their positions will, their risk will increase, normally speaking. So, fine. Now, how does that translate into position sizing in the real world? First, we discussed the fact that value at risk is the most dangerous measurement of risk you can ever imagine, for two reasons. First, volatility is going to zero, and correlation is going to zero, and tail risk is increasing in today's world.
Yeah.
Which means you look at a certain position, you look at a certain hedge fund, it has very little beta to the stock market, it has very low correlation to the market, but as long as the market doesn't go down more than 10%, everything is fine. The market goes down 10% and the hedge fund is down 30%. That's the kind of the quick. So volatility is not something you can rely on. Correlation is not something you can rely on.
Sure.
So the way we build the portfolio is we use a drawdown expectation across different factors as a measure of portfolio construction. So we're trying to normalize exposure to different factors. So suppose you have 5 factors, we would allocate equally from a drawdown expectation perspective to each of the 5. It's not done numerically. It's not we can do it numerically, but numerically, the more, from my perspective, the more math you utilize, the less you know about what you're doing.
Right.
The less you know about the reality of the world out there. The more you know about the reality of the world, the less math you utilize.
But how do you set the drawdown expectation, though, for a given factor?
Okay. So in our second research piece, we explained the relationship between volatility and drawdown based on skew.
Right.
So for the CTA industry, a drawdown, I'm talking peak to trough drawdown, let's say over a 20-year period, is about 1.5 times your volatility.
Right.
That's for the CTA industry broadly. For strategies which are more positively skewed, drawdown is about 1 time volatility. And for hedge funds which are negatively skewed, drawdown goes all the way down to about 10 times volatility. And the proportion of drawdown to volatility is based on skew.
Right.
So every time the skew goes from 0 to -1, you have to increase your drawdown expectation by 50% of volatility.
Okay.
Now, now we don't actually. Okay, so this is I'm giving you one way of estimating drawdown based on vol and skew combined.
Sure.
You can also look at it through simulation. We have the benefit of, having simulation over our strategies, and that also gives us an estimate. Now, I cannot give you a broadly speaking, if you look at a simulation over a simulation that you expect to be stable for a factor that you expect to be stable that works broadly across all markets, I would say that if you assume that drawdown is going to be 50% more than simulation,
right,
I think that's pretty safe. For things that are unstable. So if you're looking at things that rely on the stock market or on the Fed or on bottom picking, etc., then drawdown should be 20 times, 30 times expectation.
Yeah,
because it's been extremely low.
No, that's true. I mean, so when you look at your original program combined and you take into all these factors that you have and models and relationships, what do you see? I mean, do you see that the 1.5 times your annualized volatility is what you would expect to lose at any one time, or and is that how it's been historically, or have you been able to improve it a bit over time as well?
We're more positively skewed than the CTA industry.
Okay.
Therefore, I would expect our drawdown to be a smaller multiple than the BTOPs relative to our volatility.
Right.
We target 20% volatility. Our historical peak to trough is 24%.
Okay.
That was in 2004. I think we've improved since by diversifying the ways that we measure volatility, but we're human. So I would say that now, just broadly speaking, for example, our return to drawdown is actually higher than Winton's.
Right.
So since, you look at since May of 99, so we've done an okay job, I would say, in terms of balancing returns and drawdowns. Yeah,
sure, yeah, definitely.
Yeah.
Now, in terms of implementing all of these models and the trades, how busy or how relaxed, so to speak, is it in terms of the day-to-day implementation of the trades in the original program?
Okay, again, it's a question of balance. So at every place within the firm, you can have potential bottlenecks if the individual in charge of those functions is not busy enough, or if he's too busy. So if your trader goes to sleep because nothing is going on all day,
sure.
That's not a good thing. If he's too active, then again, his efficiency is going to go down. So we try to balance things in a way that we keep people just busy enough, let's say at 30% of capacity.
Okay.
In terms of everyday operation.
Sure.
That keeps them alive, thinking, in touch with the markets, and be able to provide us feedback and to improve their process constantly over time.
Mm-hmm.
So from my perspective, I'm not involved at all in day-to-day operations. Sure. I would say research, so Paul and Nan are maybe spend 10% of their time in being involved in everyday operations, more in terms of like designing new reports for clients, et cetera, et cetera. Mm-hmm. And the trader, I mean, trading is automated. We can automate it more. We don't feel it's necessary. Yeah. So, again, you don't want too much pressure. You don't want too little pressure. The technology and the know-how to automate today is available for very cheap.
Mm, sure.
It's available and it's not value added. It means, using algorithms to VWAP over time, etc. It does not improve on your slippage in the long term. It does so when the vol is low and you don't really have to trade. So there's some pretty tricky things here. When you look at when you're executing and the market is not moving, whether you trade your trend following signal today, tomorrow, in 1 week, or in 1 month, it doesn't really matter.
Sure.
Basically, it says don't trade.
Yeah.
Now, when the markets are really moving and you get a trade signal at 10 a.m., if you execute it at 10:10, you've lost like 70% of your profit.
Right.
Okay. So now, when it comes to creating capacity, there's limits in the real world, especially when markets are moving. There are no limits when markets are in low vol environments.
Of course.
Trend following strategies are very stable. The typical long-term trend following models are very stable in terms of return generation. So you can trade, you get a trend following signals, you can trade tomorrow market on open, you can trade the day after market on open.
Sure.
You might lose 5 to 10% of your profit, not more.
Yeah.
Okay. So it's important to know the value of automation, not to just jump into it because it's available and sounds good. For me, the moment from a mental perspective, I've lost touch with the process, it becomes a risk source.
Sure.
Automation is a risk source. It's not only something that simplifies everyday life.
But how would you then, I mean, does that mean that today you simply implement, so if you get a signal, you let the system implement the full position straight away?
No, absolutely. No. So depending on the type of orders that we have, sometimes, for example, for the index, we're trading market on open.
Sure.
And depending on our size, we might actually view up over half an hour or 2 hours, or do everything market on open.
Okay.
So for I would say non-alpha type of models, whenever you can be part of the opening cross, you should do it because that's the lowest transaction cost point.
Sure.
Then VWAP, you start trading, you start actually paying a spread.
Yeah.
From a perspective of the faster models that have more alpha, that utilize stops for trading, there we actually have our own algorithms, which are not automated. It means the trader has a certain rules that he has to follow in terms of how he executes a trade.
Okay.
Typically, 50% of the trade is done immediately in the market.
Right.
And then depending on the conditions after the stop is triggered, between that first 50% being executed and the time for the second order to be potentially done, depending on the sectors and on conditions, there's different rules that a trader follows.
Okay.
But generally speaking,
can this be automated, Nigol? Do you think? I mean, or because that's obviously a if you're gonna double or triple your original program, that's obviously requires more manpower then.
Not the process does not need to be automated. Today, for example, we're only manned during U.S. hours. We don't, overnight we give our stops to banks, for example.
Right. Okay.
But I would say that we would have to have somebody in-house 24 hours a day.
Sure.
But the automation does not need to be more than it is. Okay. So size is not an issue from where we are. I mean, we have over $1 billion in capacity in the original program, and I would say between where we are and trading $1 billion, we would need the night traders, not a different process.
Right.
Yeah. I mean,
and just out of curiosity, when we talk about risk and we talk about trades and so on and so forth, just maybe for people to better appreciate. And obviously it's not a specific number necessarily, but what would you say the risk is on any given trade? And I don't even know, because I didn't ask you, but I don't even know whether you use a fixed stop loss for everything you do, or whether you have to have other conditions met before you get out of a trade.
No, we always have a fixed stop loss.
Okay.
Now, again, because our strategies are all positively skewed, the stop loss is very close.
Right.
For a mean reversion strategy, I mentioned 2 daily ranges away. For what we do, which is more positively skewed, it's much smaller than that. So we always have a stop loss, no matter what, non-conditional.
Right.
Yeah.
And I want to sort of move a little bit from risk management towards towards the subject of drawdowns. I know we've talked a lot about it already. I want to try and do it in kind of a way where I get to ask you and hear your opinion about some of the questions that I normally do. And clearly the environment since 2009, as we've touched upon, has been different. And what we've seen is that some, probably more classical trend followers that I don't think is doing what you've mentioned with the 7 factors, have seen their drawdowns, expand, probably because of the collapse in volatility to a large degree. But you've actually done, quite well, if I may say, in this period. How do you view this sort of environment? And if I can ask, were you expecting actually to do so much better than maybe traditional CTAs in a period like this? And from the drawdown you talked about earlier, to put that into perspective, what did you learn from it?
Well, I mean, we're not targeting to be trend follower or to be a beta. We're over our history, we've made about 7% of annual alpha to the B-top, and we continue to do so even in this environment. So this environment has changed the returns of our beta to the CTA industry, but it hasn't changed our alpha really.
Sure.
Okay. So would I expect to do better? I mean, generally everybody expects to do better, so I would say I'm one of them. Now, this environment has gone on, I would say, definitely longer than I expected in terms of the vol compression. But considering the economic environment and the political environment, I would say there's less and less room for markets to be normal. It means if we allowed interest rates to go where they want to go normally, the economy would collapse. If the Fed, overnight stopped, their bond purchases, you would have serious issues everywhere, whether it's the real estate market and the rest of the economy. So today we're in a place where markets need to be controlled more than ever. In the context of that, the fact that the vol has compressed the way it's compressed is understandable. And therefore, the returns that the typical CTAs are experiencing are also understandable. Now, not only are central banks providing free puts, you have the hedge fund industry, which is selling tail risk. That tail risk is not seen by the end investor because he gives the money to a hedge fund. The hedge fund goes and shorts the puts or, puts on a credit position. He only sees, very low volatility and stable returns. He's not scared. So when you give your money to an institution to manage, the institution can take more tail risk, and which the investor doesn't see. The transparency is not there anymore. So you have the hedge fund industry selling tails, and what the internet bubble used to be in 1999 and 2000, today selling tail risk is that for the market. It's the source of the returns.
Right.
So you look at retail websites, they tell you can short the VIX by buying an ETF. You have ETFs that are provided, that actually short calls on your, on the S&P, et cetera. The alpha, people are looking for alpha. They're not, they don't really care about the price and the risk they're taking for that alpha. In that context, there's again a self-reinforcing confidence dream going on, which is the vol is compressing, and CTAs that actually are betting on a normal market, which is a much more reasonable position, are paying the price. It does not mean that reality has been erased. Reality is lurking, and it will come back. There's no way around it.
Yeah.
There's no central bank that can change this.
No.
Yeah,
I agree. Now, you mentioned you had a drawdown of 24%. Just remind me, when was that actually?
That was in 2004.
Okay.
And the majority of the drawdown came from foreign exchange.
Okay.
And effectively at the time, Bank of Japan was kind of supporting dollar yen. And there were many consecutive losses, and the way we filtered for volatility did not take into account for central bank interventions, where today it does so much more than before.
Yeah, I actually wanted to go in a different direction also with that, and that is, and luckily for you, it's been a long time since you had this drawdown, but maybe I can benefit from your memory, and that is, can you describe what it feels like being in a drawdown? Can you describe that? Because I don't think many people knows what it does to a manager when they get into a drawdown, and it can either be a deep drawdown or it could be a long drawdown. But why is it, or why can it be difficult to deal with these things from an emotional point of view?
You see, if you haven't done your work, then a drawdown is extremely unsettling. If you don't know your models, if you're shorting volatility, then having a drawdown is a very scary thing, because you don't know when it will stop. So the more prepared you are, the more you can handle the drawdown. Now the drawdown is not a mathematical, random walk. It's something very specific that has a very tight and very parallel reality in the world, in the psyche of the manager. It means when we go into drawdowns, it's just when we think that we're going to make money. Then when we're in the middle of the drawdown, we go, oh my God, it was so obvious. We were so confident, and we were making money so consistently that we lost track of the potential risks. That's like somewhere in the middle of the drawdown. Now, at the bottom of the drawdown, you're like, oh my God, like this is where I would say you have the urge to override your model.
Right.
You have the urge to change the models, to do new research, which filters out the specific market conditions that created the drawdown.
Sure.
It's the same thing, but in the language of a CTA. It's like, oh yeah, I redesigned my models. That's what you hear. Yeah. So now I have to say something. It's very important to know the difference when you have to react and when you don't have to react. And for that, personally, I've, for close to 20 years, I have a meditation practice and a yoga practice that keeps me detached enough where the risk that you're supposed to take, you have to take, you cannot be scared of, but the risk that you can avoid, you have to avoid. And to see the difference, you need to be very clear.
Yeah.
If you're scared of your clients leaving, or if the psychology of your clients influences you, and you're trying to protect the business, you're going to guaranteed get out at the bottom of the drawdown.
And that's actually where I wanted to go, because what you're saying is so important. And I think it goes to many managers that obviously a manager can look inside, and obviously I assume here that it's a manager that has done their homework, not just someone who's, put it together in a quick spreadsheet and so on and so forth. But the confidence that a manager has from knowing the models and having done the research, when you go into a drawdown, whether it's deep or whether it's long, you have the confidence that you're going to get out of it, and this is not unusual. But what has been really difficult in many instances is to transfer that confidence to the investors, because we all know investors usually bail out right at the wrong time. So have you found a magic formula to give some of that confidence onto your investors? And if so, what's the best way, in your opinion, to do that? Because that's the critical part.
You see, Neil, the way I see it is the mind, if you try to intellectually control a drawdown, you are not finished from the drawdown yet. At the end of the drawdown, your confidence should be shaken. If you're still confident, it means you're delusional.
Mm-hmm.
You have to be scared. When you are scared, after you've done all your work, is when the drawdown can end. Mm-hmm. And this is what I'm saying. I know it sounds bizarre, mm-hmm. but it's really, there's a major parallel. Like I almost, like, if somebody can sit and watch my emotions, they could tell when the drawdown is going to end.
Right.
So now what can be passed to the client depends on the maturity of your client. I mean, we were lucky that again, from 2003 to 2010, our single client was actually a CTA.
Right.
Now, we lost confidence before they lost confidence.
Okay.
So we actually told them, we don't know for how long this is going to go on. And it was our first drawdown, so we had less experience with this type of thing. Mm-hmm. We actually told them, we think you should reduce your allocation by 50%.
Okay.
We lost confidence, not them.
Okay.
And now, since then, we've gone through many drawdowns. We've gone through a 20% drawdown, 15% drawdowns, a few times, whatever. So there's been a few where, we've done more work on the systems, and most importantly, we've done more work on ourselves. Mm. So I think we're clearer in differentiating our feelings in terms of projections of our fears versus what the reality is doing out there.
What would shake you today then, Nigol? With all the things you've gone through, what would keep you awake at night? What risks do you see when you look at your design, when you look at your portfolio, that could get you back to that situation where you might recommend to a client to redeem 50%?
Based on where the volatility is today, see, if you analyze our drawdowns have come in periods where the vol has contracted dramatically. And when I say dramatically, I'm talking about 75% reduction in the level of implied vol in a market, for example. Mm-hmm. So you look at the VIX 09, it was at a peak intraday around 90%. When it went down, 75% is, 2009, the typical drawdown for CTAs. In 2004, it was the volatility on the currencies. We recently went through a 10% drawdown. We're halfway back up or more. The volatility on the currencies went from, call it around 18%, all the way down to 4 and 5%. So when you see these type of vols, we're going to expect a drawdown. If we don't have a drawdown, it means we're not actually trading our strategy correctly.
Yeah.
Now, when will I be shaken? I mean, I believe 100% in human beings, the crowd psychology, and the fact that they are not able to control their emotions in the market. And I believe that will continue to give us opportunities. What I worry about is how desperate central banks can be.
Right.
And how far they will go in terms of controlling markets. Now, we've done certain things to counter that, to be able to filter some of that out. But of course, it's nothing. Nothing is certain.
No, of course.
So, the type of confidence that you're looking for, I hope I never have. because it means I'm missing something.
Right.
But what I can tell you is the more honest you are with yourself and the more honest you are with your investors, the less pressure you have to deal with, and the more you can focus on the reality versus the illusion. Yeah. So for me, do we provide an extreme level of transparency with our clients, and that gives me the ability to focus on what I need to focus on, not to worry about if I said something incorrect and now it's going to come out. I'm worried about that, or I'm worried about what people are going to think about what I'm doing. You know, if I know I'm doing the right thing, that's going to give me a type of confidence that I need, not what clients are thinking. The wisdom, I mean, I know the product hopefully better than our clients, except, you know, in that case.
Sure.
So confidence, there's self-hypnosis. It can work. It's also dangerous. Sure. It's very good when you're selling a product. It's very harmful as a manager.
Sure.
As a manager, I was taught to always be paranoid.
Yeah.
Actually,
yeah. No.
You see what I'm saying?
Sure. Absolutely.
Yeah.
Absolutely.
Yeah.
Now, in terms of sort of research, you know, a lot of investors, they want managers to do research and to innovate, but they don't want the managers to change. How have you come across that situation, and how do you balance that?
Well, you have to have wise investors. So in our case, our investors are, you know, mainly very large pensions, and we have very few fund of fund as investors. Not to say anything negative about fund of funds, but really that's the way it is.
Sure.
Now, research is a must. Research driven by greed leads to seeing things where there's nothing to see.
Right.
So if the investor, if you're not clean yourself as a manager, then you're desperately looking for something that's going to work. You're going to cheat yourself and your investors. That's very, very important. So if your investor is pushing for research, he wants to see that you're alive, you're interested in your business, and you're doing your work, you're keeping up with the markets. It's very different than I'm scared of my investors because I need to do this for them. You know, it's a different mentality. Now, the market provides many opportunities for people who want to deceive themselves, sure, especially in today's world.
Sure.
So I would say research is very important, not because the client says so, because I have, for every idea that we research, we have another 3 ideas that come up.
Sure.
So our minds are constantly coming out, and this is how we spend our mental energy, is trying to find better ways, or trying to understand the patterns of volatility in the market, or the pattern of behavior of the crowd better all the time. This is what we do this is what we breathe. Okay. This is, I believe, a good motivation. If it's driven by the clients, it can be misinterpreted. Okay. So now, I would say our clients sometimes push the research in certain areas of interest to them. We've learned a lot from doing that. It's been very, very useful to us because they have a different perspective that we sometimes have lost. I mean, we're inside the CTA, they're outside the CTA, and they're holding an equity portfolio, and we're not.
Sure.
So the clients have guided our research very, very often. The fact that we've developed the replicator, the replicator was developed at the request of Equinox, which is,
sure,
a client came and said, "Can you do this for us?" We thought it would be a terrible idea, but it's like, "Hey, they want it, let's do it." And next thing you know, that's where we raised a lot of money.
Sure.
The equity hedge product is the same thing. It's like we're sitting in front of the client is going, "Well, you know, I don't know, your market is going to go down. I really don't know whether you're going to make money or not." And eventually we said, like, listen, we'll just give you the trades which are negatively correlated to the stock market, and then we're providing you a hedge. We're not going to be long the stock market when it drops, and we're not going to correlate. So the client, listening to clients is very important, but not with the idea to you have to be very careful that when the idea comes from the client, the potential for self-deception is much higher.
Sure.
Okay, that's what I want to say.
Yeah, and speaking about sort of deceiving yourself and deceiving people looking at it, back tests. That's what we rely on when we do research. But there's never been a bad back test, at least not publicly. So, so how do we? I know. I mean, in a serious way, how do we get confidence from a back test? Also knowing that markets are not necessarily going to look exactly the same in the future that they have in the past. How do we do that?
There's no information in the backtest that can answer that. The way you can answer that is by knowing the path that led to the backtest. So when I show you a result, you have no idea what I did to get that result.
Sure.
Did I run 10,000 different tests, or did I run one test? So the way the research process works is there are mathematicians that know, for example, let's say, broadly speaking, know less about the market, but can run thousands of backtests in a day. They're the most dangerous. So mathematicians, PhDs are highly optimizing machines. They're very sophisticated optimizing machines. They don't know the fact that the market regimes and the market character can change. And because they identify with their intelligence and they want to apply it and they want to prove that they're smart, they tend to over-optimize. This is what they were taught. You're a good mathematician if you design a good model which perfectly matches the sample data.
Sure.
In the market, you don't want that.
Yeah.
That's actually a negative. So going back to your question, how do you know whether a backtest is worth it or not? There's many things. You start with all the basics which are intellectually palpable, such as transaction costs and other technical problems that can arise. All the assumptions have to be correct. Then you have to follow the idea of the researcher. Where did the idea come from? Did it come from a previous test or running 10,000 tests you put a machine down and it optimized, or it came from a macro concept, something that you had, an image of a market pattern. So for us, when a researcher does a test, that's the biggest in a business. There's operational costs. I would say to the client, the risk is when a researcher does a test and does not actually communicate that to me. And therefore, the degree of optimization is increasing without me knowing, and therefore I misinterpret the results of the backtest.
Sure.
So that's really critical.
Yeah.
So it's the path to the test. It's not the test itself. There's nothing on that graph which always goes up, which tells you anything.
Sure.
Now I'm simplifying. In today's world, again, I want to say, when you go deeper into the backtest, you look at specific factors. I mean, I've been running tests for over 23 years. I've seen probably thousands and thousands of backtests. I know some of the factors, the potential optimizations, some of the potential deceptions better than somebody who's coming in today into the market just fresh.
Sure.
So by looking at factors, by looking at relationships to equity markets, relationships to fixed income, you have to know the market. You have to know exactly what fixed income has done. You have to know exactly what bottom picking has done in the stock market. If you know those, you're already going to eliminate 90% of great backtests. Sure. So then the rest is, so there's a lot of information, but it's more information, and memory is important, but being awake is more important.
Absolutely.
Yeah.
Now, just maybe as a final question, a little bit about research, which is something that I also know that a lot of the people listening are interested in, and that is, how do you know that a model has stopped working?
Again, hopefully you never think you know. Because if you really think you know, then you're really in trouble.
Sure. But no, I guess my question really is, are there any sort of yellow flags, red flags that you are looking for that might suggest to you that something may not be as you would like it to be or what it should be?
I mean, let's talk about trend following, broadly speaking, maybe.
Sure.
Did trend following stop working? And based on what would you say today that it hasn't stopped working? Right? I mean, it's something like that.
Sure.
So if you go back and you say, well, first in the market, what can I see? Mathematically, if I look at it, going back to, some people go back 100 years and they say, well, it's worked, hasn't worked. Maybe transaction liquidity has gone away. And I would say then it definitely stopped working. It means we cannot trade this time frame anymore because liquidity is not there.
Right.
That's obvious.
Sure.
Now, let's say everybody is doing trend following. So you go in a street corner, instead of seeing a stock brokerage firm, you see a bunch of trend followers discussing trends on the wall.
Sure.
I would say it's possible that it's going to stop working for a while.
Yeah.
If central banks become more desperate, I would say it will stop working for a while as well. If human beings become extremely emotionally detached, it means they're able to separate from their feelings and they don't act in the way of a crowd. I would say that trend following will stop working. If risk premia are correctly priced, it means everybody has a fully diversified portfolio. They don't need to buy insurance anymore, and therefore markets will be correctly priced. You will not get paid extra for providing liquidity to a farmer or to a bank or to whatever. So there are things that will kill certain strategies, but I don't see any of them of those happening.
So it's more these causes that you would say that you're looking for, not so much necessarily the performance of a model, because and I remember from one of my early interviews with Mike Dever from Brandywine, who had been around for a very long time and certainly knows a few things about trading. In his program, he described that, we can have models that don't work for 10 years. It doesn't matter because we base it on return drivers, and return drivers will have their own environment in which they work. So if we can diversify across different return drivers, we accept that not all of them will work at the same time. Is that a little bit the same you subscribe to?
I agree. You have to have a fundamental understanding of why the pattern that you're trading actually works.
Mm-hmm.
That will give you much more information than the numerical observations. So if you look at it numerically, which is far away from all these examples I was giving,
sure.
There's it's basically a biased random walk hitting. What is the probability of it hitting a certain amount of drawdown? You calculate that probability.
Mm-hmm.
You say, if it's less than 1% possible for this drawdown to happen, it means the model broke. I think that's the least useful type of approach.
Sure.
So every model that you have in the future will have a larger drawdown than the one you expect.
Yeah.
So it's a question of understanding whether the market conditions have changed versus what you expected for this to happen or not. But it's not a mathematical process. Although we're running, a quantitative approach, etc., math has to be used as little as possible.
Yeah, no. I mean, it's fascinating. It's very interesting. Do you think, and this is just something I thought about now, but given everything you know, everything you've learned, do you think your worst drawdown is behind you or ahead of you?
It's very difficult to differentiate the intellect from hope when you ask a question like that.
Sure.
So immediately my mind started calculating: is he potentially going to invest? So realistically, the biggest drawdown is always ahead, no matter how good you get.
Sure.
Really. So I would say it's better to assume that.
Yeah. But then again, also probably the best period is ahead of you, because that logic tends to, or should be applied both ways. Anyway, that was just something that it's interesting, and you clearly have thought a lot about these things. I want to shift gear on you a little bit, because I have a couple of more sort of key areas that I just want to cover, and this is just a little bit on the business side. I want to get sort of to understand your views on that as well, and that is We know it's been difficult for in terms of markets, and maybe again, as I said, and very happily to point out that you've done well through this period. But it's been challenging for the strategies in general, and obviously for investors' perception of the value of a lot of these momentum-based strategies. But it's also been difficult in some ways in terms of client retention for many firms. What has your experience been? I know you've mentioned one example where a large investor had to redeem and you replaced that with other things. But I mean, what's the biggest challenge and when it comes to these things and running a business? If we now put the hat on you as the entrepreneur, the businessman, and not the researcher and the scientist, so to speak.
Yeah. So again, I would say the key thing is to first, in the past, the profitability of a CTA business was much higher than what it is today. It means you put less resources to work, you charged higher fees, and there were less CTAs out there who, so the competition was in the market was much more inefficient, let's say. That's key. The market is very, very different, and it is accelerating since the, call it the replication wave has come in. We're saying 90% of returns of the industry are replicatable. And if you look into specific factors, I would say over 90% are replicatable. So that's one aspect to be clear on. It means you have to accept as a businessman that you're going to have to put on much more cost into the business, and your profit margins are going to be those of a regular business. It's not going to be 80% distribution to shareholders anymore.
Sure.
The hedge fund industry is used to that. So that's one key aspect. The other aspect is, so this is from a business perspective. Now, another aspect is if a manager is not in touch with the reality of the market, then he might actually misposition his products and his services. So he might be out of the market. There's a bid ask somewhere, and if you're not in that bid ask, you're not going to trade. So we see with the CTA business, it's exactly the same thing. You have to know what investors are looking for, what they're willing to pay for it, and whether what you're proposing, what you're offering, no matter where you come from, whether it's near that market where the trades are actually happening.
And I guess that is why you today offer, as I started out by saying when we started our conversation, you seem to be providing solutions that investors are looking for, rather than just focusing on one product.
Absolutely. Now, of course, I would rather, just do what I think is right, but it's not long term. That doesn't serve anyone.
Sure.
Right. So the approach of kind of having a two-way street with the investors, building products for investors, and also telling investors sometimes how they're misinterpreting market characteristics is something which is most constructive in the long term. So the key communication is always very important, which means you have to be open with yourself, and then you have to be open with the investors. And from there's the potential to understand each other better and to therefore serve each other better. Now, you don't have to be, a rocket scientist. You have to have common sense and clarity. From there, products can be developed and people have needs, and hopefully you can serve them.
Have European managers been better at doing this in the last 10 years when you look at the fact that they have become the powerhouses of the industry relative to where the industry started, namely in the US? Is that really the reason why we've seen this shift, do you think, or is that based on other factors?
So it's a nationalistic pride that made it maybe. I mean, okay, the US, you see, I have an investor that always says geography is destiny.
Right.
Okay, if you live in New York, you're not going to first invest in a CTA. You're going to invest in the New York Stock Exchange.
Right.
Okay, if you live in Chicago, you're going to invest in CTAs before you invest in the stock exchange.
Sure.
Okay, so now let's say you live in Europe, your idea of the world is going to be more biased towards the reality that you're living in versus the one that people in the US are seeing. In the US, the psychology is very broadly, very like pro-America, pro-business, pro-stock market. Again, it was considered, unpatriotic to sell stocks. during the crisis. It's like, we should buy it, whatever. It's like, so this influences investor decisions. So I would say that Europeans, generally speaking, have had a broader, more open-minded perspective on the world, in which they have not been pushed away from CTA type investments as much as US investors have. Now, European stock markets are up since the bottom in 2009, are up maybe 40 or 50% of what the US stock markets are up. So European investors still, so it's not CTAs in a blank world, it's all relative to the other investments available. So I would say Europeans are more scared of corrections, where in the US, I would say investors are very confident that the central bank will make the stock market go up forever. So these type of things are a big influence. Now, technologically, I would say, again, Europeans are more advanced mathematically, broadly as a population. They understand and they're more friendly to quantitative strategies. Where in the US, people believe in value. They believe in Warren Buffett, the fact that you can buy something which has deep value, such as Coca-Cola, and it will go up forever. And you can get old and just, take the benefits from the stock. Very different psychologies. So Europe, at least at a high school level, is much higher, mathematically and that sort of thing. So these things influence investor behavior. Sure. Now, the CTAs themselves, I mean, you can look at the Aspect Winton Mann trio type of thing. They did certain things starting in 2002, 2003, such as the inclusion of carry strategies, risk-on strategies. Those things at the time were novel, and they therefore provided better risk-adjusted returns for a while. So you got to give them that. So now they're in a position, they have a very strong position in the industry that they've been able to sustain. Winton continues to grow and continues to create, pockets of value that are not potentially from the CTA space, which is fine. You have Transtrend, et cetera, which has provided, some very creative approaches to evaluating markets and spreads. And you have some very good short-term traders as well. So I would say Europe has definitely succeeded much better than the US in the last 10 years in the CTA space.
Yeah, no, it's very interesting to see for sure. Now, before I jump to the final section, I want to ask you a question that I try to remember at least to ask everyone.
Yeah,
and that is the fact that you clearly, as well as I would say all of my guests, have been in many due diligence meetings, questionnaires, conference calls, what have you. But I want to ask you what you think investors are not asking you in all of these situations that they really should be asking you.
Well, you see, the most important question in the investment world today is how to price tail risk. It's not how to price equity risk. And same thing in the CTA world. If I give you a CTA that has zero skew versus CTA that has -1 skew, what should I expect in terms of additional returns per year? That's the most basic question. So in the same way, in the 70s, I guess 60s and 70s, people started to learn about stock market beta and learned how to price stocks more efficiently. Today, investors have to be asking about the pricing of tail risk. When they do that, the hedge fund industry will have, the incentive fees that the hedge fund industries will not exist anymore. And investors will have less surprises. So when they invest in a manager that has, 10% vol, but it goes into a 70% drawdown during an equity crisis, they will not be surprised. So this to me is the most important question, whether it's in the CTA space or the hedge fund space. The confusion between alpha and scale is still too prevalent considering the information that is known. This information is the fact that managers are not taking local risk, they're only taking tail risk, and investors still cannot tell.
Sure.
Yeah, that to me is the question.
Okay, great, fantastic.
Yep.
Now, let's move on to the final section, which I define as general and fun. So a little bit of everything.
Okay, that's quite a change in
exactly. Now we've done all the serious part. Now we do a little bit of different things here. I just want in very short, if you can sort of just shortly define, what do you think it takes to become a great manager or trader? Because a lot of the people listening are perhaps people who aspire to become, the next Quest and so on and so forth. So what does it take nowadays, do you think?
I would say 20 years ago, it didn't take much since I made it through. But today, I would say there's a certain clarity of mind to be able to question your own mind is very, very important. Not to have unwarranted conviction in wrong areas, just to simplify your life. So I would say today, for any business or any activity, as a matter of fact, having a clear mind, which is not driven by your own desires, but which is driven by reality, is the most important skill in anything.
Sure. No, great. And I have a feeling I know what the answer is, but I'm going to ask anyway. And that is, a personal habit that you have that you believe has contributed to your success.
I guess you do. You probably do know the answer. Yes,
sure.
I've been. I've had a daily meditation practice for 18 years now.
Wow.
I haven't missed a day, and it's a very, very important habit because it's like people have the habit of taking a shower in the morning.
Sure.
If they, so meditation for me is like a shower for the mind.
Yeah.
So the leftover memories, reactions, bad effects, good effects of everything you did yesterday, of what the market did yesterday, is in a way erased, and you can see the world fresh and clean again. It's very, very important, especially as the industry becomes more competitive, markets become more hidden, like the reality of the market is hidden, like the real price is not where the market trades. It's influenced by central banks, so there's a lot of hidden factors. In this type of world, if you don't have a clarity of perspective, if you're too influenced by your knowledge, by your memory, you're doomed to fail.
How did you come to start doing that, and how long does it take to do every day? Sorry, I'm asking some personal questions here, but it's fascinating.
The reason I started is because I realized that the way I saw the world was not the way the world was.
Okay.
So my perspective of the world, and actually it was in relation to the death of, somebody in my family.
Sure.
I said, nobody ever taught me what happens after this. So how come, all this education and everything I thought I knew was such a shock? And as a result, I said, let me go and actually see what is it really like? Is there a way to get an answer to this? Mm-hmm. And very quickly, I realized that the mind, the intellect, knowledge can be a negative. It can be a luggage in seeing life as it is. So I started out of necessity, and it had, many positive effects. Now, time, I would say, is not. There are there's meditational techniques such as transcendental meditation, etc. They say 20 minutes a day, twice a day. Great, and I agree with that. I think that even doing 5 minutes a day, sincerely, has a very, very powerful effect already. So I would say the discipline of doing it every day is more important than the time.
Right.
Yeah. So even 5 minutes a day done correctly will have a very profound impact on all aspects of life. Now, from my perspective, I also once or twice a year go and spend 7 to 10 days in silent retreats where all the toys that the mind grabs on and holds on to are taken away from you. And therefore the mind surrenders, and other aspects of your personality can actually be seen by you more clearly. So it's a very, cleansing process.
Right.
And your creativity really is magnified, and your perspective on the world, is very, very different.
It's fascinating. Actually, one of my previous guests also did, meditation on a daily basis, and I seem to have read when you read about people who have become successful in many fields. Very often you see some level of meditation or allowing themselves to spend time on the internals rather than just the externals as a factor. So I'm fascinated by this, and I appreciate you sharing that. That's for sure. What is the most difficult thing about being a CTA you find?
Well, again, it's like you feel like you're fishing in a very small pond. In a way, it's like we created a self-defined box, and now the box is our prison. So CTAs, by defining the style so independently from the rest of the world, so far away from the equity world, in a way have created their own prison. And in today's world, I feel like, the big guys are playing in a different world, in a different pond. And that's a prison that we created.
Sure.
By the way we defined ourselves. I would say that's the most difficult aspect of being a CTA.
Sure. And you're obviously, as I mentioned earlier, you're also an entrepreneur. Did you always know that you wanted to be an entrepreneur one day? Is that in your Armenian blood that, I have to have my own business? Or was it more sort of other things that led you to maybe the detours where they didn't give you the chance to become a CTA, forced you to take your own initiative?
No, again, I mean, our personalities are shaped by many generations of experiences through, it's not only our experience, but the generation of our parents, grandparents, etc. And it was, my dad and grandfather always told me, like, first chance you get, you should start your own business.
Okay.
And I didn't take them seriously. I was like, why would you do that? You have such nice, great, big companies you can work in and not worry about anything. But somehow the depth of the feeling when they said that stayed, in me. And over time, I remembered it and I took that advice.
Fantastic. Great.
Yeah.
I have two questions left, I think. And I want to ask what as business people, as managers, etc., it's not a straight path. It's not just an up, a slope going up. We have hiccups, we stumble, we fail along the way. What would you say has been your biggest failure in achieving what you've achieved? If I can use that word, I mean.
Yeah. No, absolutely. I would say not realizing. Okay, I would say the biggest failure is not seeing in 2009, after having 2 great years, not seeing the reality of the world and the impact that central banks can have. I would say all CTAs today have, first, they've missed about 200% in return in the equity world, if they haven't lost money in their own strategies. So I would say that's like a point where there's a major bifurcation, where sometimes I say, if I had the right clarity, I wouldn't have been as driven by my own memories and my own, it's almost like your successes. You remember anything which is dramatic, and the fact that you're up 56% while the stock market is down like 40% or so, that impacts you so much that the rest of your life you're trying to relive that experience over and over. Mm-hmm. And I think that type of negative learning is something that clouded reality from me and from most CTAs, I would say, and they today refuse to be more open-minded in terms of where money can be made and where money can be invested. So I would say that's like a major point that would have made, I would have been, in a very different place if I was willing to see the world, differently at the time. Okay. But our experience for CTAs, those experiences are very marking, and it becomes very difficult to do anything different as a result.
Sure.
Yeah.
Now, you've already shared some personal things about some of your routines, but is there a fun fact about yourself that you can share? Something that even people who know you may not know you and may not know about you. Could be a hidden talent, Nigol. I don't know.
A hidden talent. Well, as a kid, I actually wanted to be a drummer.
Okay.
And and to this day, we have gongs around the office. So it's this music and sound are very important aspects of my life, and it's kind of a way that I think. A lot of times I think through sounds rather than through thoughts. It's kind of a bizarre approach to reality, but it's something that I use to take me away from the mental process. I wouldn't say it's like, I wanted to be a rock drummer.
Sure.
That didn't happen, but at least music and sound are still aspects of the way I see reality. So that's a little bit different.
So when I need a new playlist for my iPhone, you're the one to call, I understand.
I guess so.
Now, Nigol, my last question. I said earlier today that investors may not always ask the right questions. And obviously that's one of my motivations for doing the podcast. But what have I failed to ask you today? What have we missed, or do you think we've done justice to you and to your business in the subjects we've covered?
Yeah, unfortunately, yes, you have. I mean, thanks. You've been extremely accurate, and your understanding of the CTA space, the hedge fund space, psychology, business in general. I think you've covered all areas. At least you've dug very deep into all of the different areas that I have anything to say about. So I'm very, very grateful for your attention, your thought, and for doing this. I think it should be a great service for people.
Great. Now, before we finish completely, could you share with us where is the best place for people to reach out to you and learn more about yourself and your business?
I guess we have a website, questpartnersllc.com.
Mm-hmm.
They can send us an email from there, and we'll be in touch. We'll send them any information that they need.
Great stuff. And let me also say to the people listening that for those who are on our mailing list, at least, there is a link in the email that you receive this week where you can just click to say thanks to Nigol for sharing his story and his expertise. And I would really encourage everyone listening to do that because that is the best way to show their appreciation. And so let me be the first to say to you, thank you so much, Nigol. I really appreciate it. It's been a fascinating conversation, and I think your thoughts, your transparency, and your willingness to share this has been phenomenal. So I've really enjoyed it. I've learned a lot. And of course, our listeners can also find all of the details of this conversation in the show notes on the episodes of toptradersunplugged.com. So, and I also hope we can connect at a different time. We didn't get to talk about a lot of the other strategies that you do, but I think there is plenty of material to do a follow-up at some point. So I hope you will be open for that someday as well.
Thank you so much for the dialogue, and hopefully, yes, we'll do another one on another topic.
Great stuff. Thank you so much, and take care.
Thank you. Bye-bye.
Bye.
Thank you.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.